Number 1, do nothing during a market crash. If you are confident in your investing strategy and current portfolio assets, don't change your plans unless you have a compelling reason to do so. After all, you may have planned for a market crash like this one when you built your portfolio. People who sell in a panic during a crisis frequently come to regret their decision. Consider those who jumped ship in spring 2020 when the S&P 500 dropped more than 30% in a very short period. They were already kicking themselves by the time the early COVID market losses were erased by the lightning-fast pandemic rally in summer 2020. What about by the end of the year? They had missed out on 65% gains from the crash's bottom. Number 2, go shopping during a market crash. Market crashes are frequently the result of events such as the discovery of COVID-19 or the announcement that the Federal Reserve will alter its monetary policy strategy. To make matters worse, rapid market declines can force aggressive speculators who borrowed money to buy stocks and are now subject to margin calls to liquidate their stock holdings, resulting in a chain reaction of selling. But here's the catch. A market crash generates opportunities, particularly for astute investors. You may be able to splurge on stocks and funds you've been eyeing at steep discounts, or you can simply continue buying shares as usual. Index funds are the best place for new investors to start. Use them on a regular and consistent basis, then retire for the night. Number 3, dollar cost average even on the way down. When the market is volatile, dollar cost averaging your purchases is the safest way to go on a buying spree. This entails making regular purchases of a set dollar amount, even when the market appears to be scary. Dollar cost averaging smooths out your average purchase price's ups and downs, often lowering it in the long run. Spreading out your purchases reduces your risk because you won't be investing all of your money when the market is at a specific price point. Hopefully, this alleviates your concern about what if the stock gets crushed tomorrow. Dollar cost averaging occurs automatically if you invest through a workplace retirement plan. If you invest on your own, whether in a taxable investment account or a tax-advantaged individual retirement account, your brokerage account should allow you to automate your contributions. Number 4, hunt for dividends during a stock market crash. Down markets can be a good time for the slightly more daring to consider letting dividends drive your investment decisions. Many companies distribute their profits to shareholders in the form of a small dividend yield each year, similar to how banks pay interest to savings account holders. While dividends aren't guaranteed and can fluctuate, companies that pay them out tend to be more mature and their share prices are less volatile. And as long as a dividend is paid out, there will always be some gains. This means that dividend investing can be a wise decision during market downturns when share prices and returns are likely to fall. Number 5, ride the sector rotation. Moving money from one stock market sector to another is a tried and true strategy for dealing with market downturns. During periods of rapid growth, for example, tech stocks appear to perform well. Meanwhile, when the economy slows, boring sectors like utility stocks tend to fare better. So if you move from one to the other strategically, you may avoid large drops in one sector. However, not everyone supports so-called sector rotation. Kansas-based certified financial planner Desmond Henry said, "I'm not much into sector rotation. It's another form of timing the market," he then added. "You have to time when to get in and when to get out. I remember when all those stay-at-home stocks became a big deal. But by the time that trade caught on, it was too late. And even if you time the purchase right going in, when do you get out?" You can avoid this challenge while still achieving solid returns by investing in diversified index funds, which may perform well regardless of how a particular sector performs. If you own the entire market, you're already set to benefit from any of its sector's growth, which can help prop up other sectors that are struggling in the short term. Number 6, buy bonds during a market crash. Down markets provide an opportunity for investors to consider an area that novice investors may overlook: bond investing. Government bonds are widely regarded as the safest investment despite their unappealing appearance and typically meager returns when compared to stocks and even other bonds. Nonetheless, given their track record of flawless repayment, holding some government bonds can help you sleep better at night during times of uncertainty. Government bonds must typically be purchased through a broker, which can be costly and complicated for many individual investors. Many retirement and investment accounts, on the other hand, provide bond funds that include a variety of government bond denominations. However, don't assume that all bond funds are stocked with safe government bonds. Some include corporate bonds, which are riskier. Number 7, cut your losses during a crash. Sometimes cutting your losses is the best investment decision you can make. Not only does it free up money that you can use and then invest differently, but if you invest in a taxable account, you can also deduct your losses from your taxes. This tax loss harvesting investing strategy allows you to offset income with realized losses, potentially lowering your tax bill. It's best to consult with a tax professional before implementing the strategy to avoid what's known as a wash sale, which occurs when you buy an investment that's too similar to the one you sold at a loss. You could also have a robo-advisor manage your investments for you. It's worth noting that the best robo-advisors already have tax loss harvesting features built in.